Inheriting a property in California can feel like winning the lottery. What happens when you're suddenly faced with a huge tax bill on that inheritance? The good news is, with proper planning, you can significantly reduce or even completely avoid paying huge capital gain taxes. Today, we're going to dive deep into how California property inheritance works, understand capital gain taxes clearly, and explore smart strategies, including setting up and funding a living trust to protect your financial legacy. First things first, let's clarify what capital gains taxes are. When you sell an asset like real estate, capital gains tax applies to the profit you make. For inherited property, this is especially important because the potential gain and the subsequent tax can be significant. Capital gains tax is the tax you pay on the profit you earn from selling a property. That's increased in value. Here's why this matters when inheriting a property. The property's tax basis or original cost is adjusted when you inherit it, thanks to something known as the step-up basis. Original purchase price, your parents, $100,000. Value at inheritance, stepped-up basis, $700,000. Selling price after inheritance, $720,000. Taxable capital gain, $20,000 instead of $620,000. This is a huge advantage because you only pay capital gains tax on the increased value after inheritance, not the original value your family paid decades ago. There are several misconceptions about inherited properties in California. Let's quickly clear up a few common myths. Myth 1, California charges an inheritance tax. Fact, California currently does not impose a state-level inheritance tax or estate tax. However, federal estate taxes might apply to extremely valuable estates. Myth 2, you must pay capital gains taxes immediately upon inheriting property. Fact, capital gains taxes only come into play when you actually sell the inherited property, not when you inherit it. Myth 3, transferring property before death is always a smart move. Fact, transferring property to your children before your death can actually eliminate the step up in basis, increasing capital gains taxes significantly. Understanding these facts is essential to smart financial and estate planning. Now let's discuss strategies to significantly reduce or avoid capital gains taxes on your inherited California property. Strategy 1, selling immediately after inheritance. If you sell the property soon after inheriting it, the selling price often closely matches the stepped-up basis, greatly reducing or even eliminating any taxable gains. Strategy 2, move into the property as your primary residence. If you convert the inherited home into your primary residence and live there for at least 2 out of 5 years before selling, you qualify for the primary residence capital gains exclusion, which means up to $250,000 of profit for single filers and $500,000 for married couples is completely tax-free. Strategy 3, using a 1031 exchange. If you plan to treat the inherited property as an investment, you can perform a 1031 exchange. This allows you to defer paying capital gains tax if you reinvest your proceeds into another investment property. One of the most powerful estate planning tools for California property owners is the living trust. Not only does it help avoid probate, it also can significantly reduce the potential tax burden on your heirs. What is a living trust? A living trust is a legal document you create while alive, designed to easily transfer assets to beneficiaries upon your death without involving probate court. Avoids costly and time-consuming probate, provides privacy, probate is public, Trusts are private. Allow seamless asset management during illness or incapacity. Preserves the step up in basis for inherited property. A key point: assets held in a living trust maintain their eligibility for the step up in basis, meaning your heirs benefit from significant tax savings. Creating a trust isn't enough. You must properly fund it. Funding your living trust simply means transferring ownership of your assets into the name of your trust. Funding steps: real estate. Change the property title from your personal name to the trust name through a new deed, recorded at your local county recorder's office. Example: John and Jane Doe transfer ownership to the Doe Family Living Trust. Bank accounts and investments. Contact your banks and financial institutions to retitle accounts in the trust name. Personal property and valuables. Create an assignment document to list and transfer personal property belongings into the trust. Failing to properly fund your trust can result in your assets going through probate anyway, negating the purpose and increasing the tax and financial burden. A few common mistakes to avoid when establishing and funding your living trust include not transferring assets properly. Real estate or accounts never transferred correctly won't avoid probate. Not updating your trust regularly. Changes in property ownership or family situations require trust updates. Misunderstanding revocable versus irrevocable trust. Revocable trust allow changes and retain step-up basis advantages. Irrevocable trusts, once set, generally limit changes but offer other tax benefits. Navigating capital gains taxes and living trusts can be complicated, and everyone's situation is unique. Therefore, consulting experienced professionals such as estate planning attorneys, CPAs, or financial planners is essential. These experts can ensure your trust is created and funded properly, that your heirs receive maximum tax benefits, and that your estate is protected from unnecessary taxes and probate. Consider this real-life scenario. Mary inherited her parents' California home, valued at $800,000 at the time of their passing. Because her parents wisely placed the home into a living trust, Mary inherited the property smoothly without probate, delays, or complications. Mary decided to move into the home for 2 years, using it as her primary residence. Later, she sold the home for $900,000, $100,000 profit. But because it was her primary residence for at least 2 years, Mary avoided capital gains tax completely under the primary residence and exclusion. Had her parents transferred ownership incorrectly or skipped the trust, Mary could have faced extensive probate delays and potentially paid thousands in unnecessary taxes. Inheriting property in California can be rewarding, especially when you've planned carefully. By understanding capital gain taxes, leveraging strategies like step up in basis, using 1031 exchanges, and establishing a properly funded living trust, you can protect your inheritance and significantly reduce your tax obligations. Remember, proper planning now will ensure your loved ones receive the greatest benefit from your estate later. If you've found this video helpful, please hit the like button and subscribe to our channel and share it with family or friends who might benefit. If you have questions or comments or experience you'd like to share about inherited properties or living trusts, please leave them below. Remember, the above information is intended for informational purposes alone and is not intended as tax or legal advice. Please consult with your counsel before taking any steps in reliance on any of the information contained herein. Thank you for watching, and we'll see you in our next video.